Good morning, traders. Today we're breaking down the gap fill strategy. In this video, we'll cover how this edge forms, which assets it works best on, and how to validate and optimize it using order flow and auction logic. If you're serious about understanding market structure, make sure to like the video and subscribe to the channel. Let's jump into it. Let's start with the foundation. When is a gap actually created? On U.S. index futures like the S&P 500 and the Nasdaq, a gap forms between the previous New York session close and the next session's open. The New York close represents the final accepted price of the day. When the market reopens the following session at a different price level, that difference creates the gap. If today's session opens above yesterday's close, we have a gap up. If it opens below yesterday's close, we have a gap down. The size of the gap is simply the distance between yesterday's closing price and today's opening price. Now here's something important. For a gap to be considered filled, price must travel from today's opening price back to yesterday's closing price. That prior close becomes the reference point. It's not random. It represents the last agreed-upon value before the market paused. So the gap fill is not about price moving in a direction. It's about price returning to prior accepted value. And understanding that distinction is crucial. Now let's look at the data. On the S&P 500 futures, using historical session data, we can see that gaps are filled roughly 60% of the time. Looking at the statistics, we can see that gap ups are filled approximately 58% of the time. Gap downs are filled even slightly more often, around 61%. So, statistically speaking, the market tends to revisit the previous session's close more often than not. But this is where most traders misunderstand the concept. 60% does not mean guaranteed. It means there is a structural tendency. Now, if we look at the equity curve over a multi-year period, we can see something important. The edge is consistent. It's not explosive, it's not dramatic, but it's stable. And that's what we're looking for in a repeatable intraday framework. However, statistics alone are not enough, because the distribution of returns shows variability. Some days, the gap fills cleanly. Some days, it doesn't. And on certain sessions, continuation dominates instead of rotation. This is why validation matters. The data tells us there is a tendency. Auction logic tells us when that tendency is likely to play out. And that's the difference between trading a probability and trading blindly. Now, this concept isn't limited to US indices. The logic stays the same. You just change the session reference. For example, DAX futures reference the London session close. Then measure the gap from the London close to the next London open. Now take the Nikkei index, use the Tokyo session close, compare it to the next Tokyo open. That difference creates the gap. So the framework doesn't change, only the session anchor does. Wherever you have a defined close and a new opening auction, you have potential gap behavior. Now let's move into a case study. In this example from April 8th, 2025 on Nasdaq futures, we can clearly observe a significant gap up relative to the previous session's close. At the open, however, the market does not immediately rotate lower to fill the gap. Instead, the auction initially continues higher. Price pushes upward as buyers attempt to extend the move. But notice what happens next. As the market tests higher levels, participation begins to fade. Buyers are no longer willing to aggressively pay up to continue the rally. The attempt at continuation fails. And once higher prices are not accepted, the market shifts. What follows is a reversal that brings price back toward prior value, closing the gap within a few hours. Now let's validate this move using order flow and auction analysis. Now let's zoom in and analyze the open using order flow and auction principles. Right after the market opens, we actually see an initial attempt to push price lower. This early selling pressure could have easily baited traders into entering short positions immediately. But look closely at what happens at the low of that bearish candle. We see strong selling effort, large aggressive market orders hitting the bid. However, price does not meaningfully continue lower. This is effort without result. That imbalance suggests absorption. Aggressive sellers are active, but they are being met by passive buyers. Those early sellers effectively become trapped. And once that absorption completes, price rotates higher. Now look at the cumulative volume delta. CVD initially drops, confirming aggressive selling at the open. But despite that aggression, price stabilizes and begins to rally. That divergence between delta and price tells us something important. The selling pressure was absorbed. As the market rallies, buyers push price higher. Now let's focus on the failed continuation at the highs. As price reaches this recent high, we can clearly see continued buying activity. Aggressive buyers are still active, trying to push the auction higher. However, look at the cumulative volume delta. While price is testing the highs, delta remains elevated, confirming aggressive buying. But price is no longer meaningfully advancing. That's the key signal. Buying pressure is being absorbed at the top. Effort remains, but result disappears. This tells us that passive sellers are stepping in and absorbing the aggressive flow. At this point, initiative buyers begin to lose control. Those late buyers who entered on the breakout attempt are now vulnerable. They are effectively trapped. In this scenario, a logical short setup emerges. A protective stop can be placed just above this high, beyond the trapped buyers. If price were to accept higher and build value above this level, the short thesis would be invalidated. But once price rotates lower, those trapped longs are forced to liquidate. Their exits add fuel to the downside. And that acceleration is often what drives the gap fill. Ultimately, the gap was filled. The risk-to-reward profile was favorable, not because of luck, but because the entry was aligned with auction logic and order flow confirmation. Before applying this strategy in live markets, make sure you test it yourself. Run the data, replay sessions, study different market conditions. An edge only becomes real when it's proven through your own testing and execution. Statistics give us a framework. Validation gives us timing. But discipline and consistency are what make it sustainable. If you found this breakdown useful, consider liking the video and subscribing to the channel. See you in the next video.